Hello. At times, a few beginner investors would be wondering why they were not able to buy a stock. Sometimes buy orders or sell orders may be getting rejected for a stock. Stocks reaching their upper price bands or lower price bands may be the reason for that. Almost all investors will come across the terms like price band, upper circuit, lower circuit, circuit filter, circuit breaker, etc. at one point in their investment journeys. It's important for beginners to understand those terms. For some investors, they play a major role in their investment strategies. In this module, we explore in detail the price bands and circuit breakers. Sometimes stock prices can unreasonably move in any one direction in a very short period of time. Such movements may be due to events hugely positive to a company, events hugely negative to a company, heavy speculative trading, or price manipulation by fraudulent activities. This increases the volatility in the stock, putting the retail investors at a huge risk. Price bands and circuit breakers were introduced in order to keep the security and market volatility under check in order to protect retail investors from adverse effects. Price bands determine the range in which a security or a stock can move. For example, a 10% price band implies that the security can move plus or minus 10% of its previous day close price on a given day. The downward revision is a daily process, whereas upward revision subject to satisfaction of criteria is a bi-monthly process. No price band is applicable to securities on which derivative products are available. You can download a complete list of price bands by clicking on the link on the daily review of price bands page of NSE website. This file will be updated on a daily basis and is in the CSV file format. You can get to this page by visiting the nseindia.com website. Then click on the Market Surveillance link under the Regulation tab. In this page, click on the link Daily Review of Price Bands. Daily price bands are applicable on securities like 2%, 5%, 10% and 20% either way based on the previous day's close price. The exchanges don't accept orders that are set outside the minimum and the maximum of the price band. The high price of the price band is also called the upper circuit limit. The low price of the price band is also called the lower circuit limit. Circuit limits may get triggered in the pre-market session or as soon as the market opens. Also, they may get triggered at any time in the market hours. Suppose stock A is under the 5% price band. This means it can't rise above 5% or fall below 5% of its previous day's close price on a given day. Assume that its previous day close price was Rs 100. Then on the next trading day, the price cannot go above Rs 105 and come below Rs 95. Let us consider an example scenario for the upper circuit limit. If the price touches Rs 105, then it has hit the upper circuit. This happens when there are a large number of buyers. In this situation, the investors are willing to buy a stock for higher and higher prices. There will be a very negligible number of sellers. In other words, there are not enough sellers to bring the price down from Rs 105. On the screen, you can see the market depth of the stock Reliance Power in the market has. Note that the stock has hit the upper circuit of 5%. Observe that there are more than 1000 buy orders while 0 sell orders. The buy order quantity is 1,08,83,071. The recent traded quantity was only 200 at the high price of the price band. Also note the day's upper circuit limit 4.2 and lower circuit limit 3.8 displayed. Here is the chart of a stock that has hit the upper circuit many days in a row. We get to see a day's candle like a horizontal bar when the stock opens with an upper circuit limit. And there are no trades below the upper circuit limit. We get to see a lower shadow with a top horizontal bar when the stock opens with an upper circuit, trades for some time below the upper circuit limit but goes up to the upper circuit limit again. This means some trades happen below the upper circuit limit price. A stock may hit the upper circuit when there comes a huge demand for the stock. There can be many reasons for the demand to increase. a news may come out about the stock which is hugely beneficial for the company, which in turn increases the demand many folds. Now let's consider an example for the lower circuit limit. If the price touches ₹95, then it has hit the lower circuit. This happens when there are a large number of sellers. In this situation, the investors are willing to sell a stock for lower and lower prices. There will be a very negligible number of buyers. In other words, there are not enough buyers to take the price up from ₹95. On the screen you can see the market depth of the stock future retail in the market has. Note that the stock has hit the lower circuit of 5%. Observe that there are more than 3000 sell orders while 0 buy orders. The sell order quantity is 20,02,877. The recent traded quantity was only 10 at the low price of the price band. Also note the day's upper circuit limit 116.9 and lower circuit limit 105.8 displayed. Here is the chart of a stock that has hit the lower circuit a few days in a row. We get to see a day's candle like a horizontal bar when the stock opens with a lower circuit limit, and there are no trades above the lower circuit limit. We get to see an upper shadow with a bottom horizontal bar when the stock opens with a lower circuit, trades for some time above the lower circuit limit, but comes down to lower circuit limit again. This means some trades happened above the lower circuit limit price. A stock may hit the lower circuit when there is very less demand for the stock. There can be many reasons for the demand to decrease. A news may come out about the stock which is hugely negative for the company, which in turn decreases the demand many folds. Now we will see what investors can do when stocks hit the upper or lower circuits. Most of the time it's not possible to buy a stock at the upper circuit limit, as there are hardly any sellers available. If someone wants to buy a stock even at the upper circuit limit, then he or she can give it a try. In order to increase the chances of buying a stock, investors can place buy orders as soon as the market opens. Their orders will sit in the order book in a very long queue along with other buyers. There would be no guarantee of their orders going through unless a huge number of sellers come in. Anyhow, if someone wants to sell a stock at the upper circuit limit, then they can do so. Similarly, most of the time it's not possible to sell a stock at the lower circuit limit, as there are hardly any buyers available. If someone wants to sell a stock even at the lower circuit limit, then he or she can give it a try. In order to increase the chances of selling a stock, investors can place sell orders as soon as the market opens. Their orders will sit in the order book in a very long queue along with other sellers. There would be no guarantee of their orders going through unless a huge number of buyers come in. Again, if someone wants to buy a stock at the lower circuit limit, then they can do so. Investors can also try aftermarket orders or AMO for buying or selling a stock which is hitting the upper circuit or lower circuit respectively. The price bands are applicable for securities. The index-based market-wide circuit breakers are applicable for the movement of the market indices Nifty 50 and Sensex. The exchanges set the price bands for all securities. The circuit breakers have been set by the SEBI, the market regulator of India. Sometimes upper circuits, lower circuits, and circuit breakers are termed as circuit filters. Exchanges shall compute the circuit breaker limits for 10%, 15% and 20% levels on a daily basis based on the previous day's closing level of the indices. The circuit breaker system applies at 3 stages of the index movement either way, namely 10%, 15% and 20%. The market-wide circuit breakers are triggered by movement of either the Sensex or the Nifty 50, whichever is breached earlier. These circuit breakers, when triggered, bring about nationwide coordinated trading halt in all equity and equity derivative markets. The market shall reopen after circuit filter breach with pre-open call action session. The trigger limit, extent of duration of the market halt and pre-open session is as shown on the screen. Whenever the market halts, then it shall reopen with a 15-minute pre-open session unless it halts for the entire day. If a 10% movement occurs, before 1 pm, then the market halts for 45 minutes. If the movement occurs between 1 pm and 2:30 pm, then the market halts for 15 minutes. If the movement occurs after 2:30 pm, then there will be no halt. If a 15% movement occurs before 1 pm, then the market halts for 1 hour 45 minutes. If the movement occurs between 1 pm and 2 pm, then the market halts for 45 minutes. If the movement occurs after 2 pm, then the market halts for the entire day. If a 20% movement occurs at any time during the market hours, then the market halts for the entire day. I hope this module gave a basic understanding of the price bands and circuit breakers. Thank you.